Well, let's run you through the top headlines before we proceed. The government has relaxed the risk-weighted rules for the housing finance companies, thereby increasing their liquidity. The increase in funds availability with these lenders is expected to result in greater competition among them to lend more and lowering the cost of interest. Meantime, a wave of selling hits the cryptocurrency market before the Christmas weekend. The Bitcoin has plunged 25% in 24 hours, losing $121 billion of its market value in less than a week. But it was year-end celebrations that kicked in on Dalal Street. The Nifty conquered the elusive 10,500 mark for the first time ever. The Sensex too ended at a record high. There was lots of interest in IT stocks and we got support from across the board on all sectors barring metals. Those are your top stories in trade. Let's bring on board then our expert who joins in and he will be guiding us over the next half an hour. We have Mr. P.V. Subramanyam. He's CEO at Subramoney, now joining in on the show. And we also have with us Himanshu Srivastava of Morningstar India to talk about the overall fund flow scenario as well. So going to come to you both, gentlemen. But first, Bitcoin mania. The cryptocurrency has been trading volatile in the last few days. After soaring to a record high of 20,000, now it's crashed 13%. So it's around $13,000. So what really led to this fall and how are the investors gauging the movement? My colleague Ajay joins in with more details. Ajay, to you.
Well, there is panic among investor community, especially the ones who look at the Bitcoin and are participating in Bitcoins, are wanting to participate in the Bitcoin mania, which is gripping the globe right now because of the sharpness at which the prices have fallen. Almost a 13% intraday fall was witnessed today, almost a $2,000 fall per unit of Bitcoin. In fact, not only today, if you look at the last 4 or 5 day, kind of a trend, almost a third in value got wiped out of Bitcoin. And this has actually cast a shadow once again on whether this is the currency which everybody is calling as the alternative currency of the world, the future of currency and as alternative investment class. Because there are equal number of skeptics as well out there. And now they are having the laugh saying that the Bitcoin investors are having a reality check. In fact, UBS today put out a note saying that this is a bubble and this is a bubble in a long time in the history of financial market instruments. And group also calls it a massive reality check happening as far as the investor community is concerned. This comes on the back of the sharp surge in value from almost $1,800 to almost $20,000. That is the kind of surge Bitcoin saw in 2017, and it saw popularity spread out across the world. In fact, here back home in India too, we have seen a lot of developments because certain non-regulated exchanges started offering Bitcoin facility and investment products to investors. But all of them got shaken after this massive fall, and again has cast a doubt on whether the reliability of this phenomena is there or not, on how safe are they for investors if they become so volatile and are not very steady in a pattern. Then a lot of investors can actually get duped of their money as well.
Thanks very much, Ajay, for putting those details into perspective. The Bitcoin bubble looks like it's ready to burst, but we'll delve into that a little bit later, and you can send in your queries as well on the Bitcoin if you have any, though remember all of our financial experts have warned against it. But let's talk about the overall mutual fund flows, the DIIs and the kind of interest that we've seen in the markets as well. Himanshu Srivastava of Morningstar now joins in to put some perspective to that. Himanshu, thanks for joining in. November has been the second best month of 2017 with regards to the FPI net flows. However, FPIs are net sellers so far in December. So how are you reading this overall trend?
I think it will be a fresh start for the FIs. So if you see the month of December, they have started on a cautious note. There were not very significant outflows, neither there were significant inflows. As of now, where they stand at 390 million US dollar net sellers. But I think that is going to change. If you see the last 3 trading sessions of the last week, there have been net buying into the Indian equities. I think that is largely expecting a BJP making a comeback in Gujarat and winning Himachal Pradesh, and that is something that is now a reality, as we can see from the trends emerging out from the election results. I think this will definitely have a positive impact on the FI flows. But I think again this will be a really short term in nature. So over a period of time, these results will wither away, and then the focus will be on core growth which is the growth picking up the Indian economy, which so far we have not yet witnessed as expected earlier. And I think the election results will come and go, but the long-term results will be, or the long-term flows will be defined by the growth that the India will witness going forward. We need to understand that India is a stock for each and every FPI. So they will be comparing this stock with other markets. And if they find it really useful of investing in this stock on the risk reward profile, only then they will come back into the Indian market. Otherwise, they will not shy away from shunning India for some other better prospects in some other part of the world. So election result is a party time for now. FPIs will definitely, the short-term money will move into the Indian markets, Indian equity markets for a short time. But then over the long term, it's largely depending on the event oriented, and that event will be fundamental growth and the growth coming back to the Indian economy.
Right. And Himanshu, give us a sense as to, what are some of the top 3 trends that you've spotted in terms of the FPIs?
So one of the major things is that the DI pipping, as they pipped FI in terms of flows, and that has provided a much needed stability to the market. In the past, what we have seen is whenever FI are buying in bulk, the market shoots up. Whenever they are selling in bulk, the markets move down, and that trend has reversed this time around. So it has provided much more stability to the markets. And the other thing is that I have not seen long-term investors leaving Indian markets. So one of the segment that I track from FPI is India-focused offshore funds, and that is where I have seen that it's largely through India-focused short-term.
Note, Himanshu, thank you so much for joining in and sharing with us your perspective. Let's bring on board then Mr. P.V. Subramanyam to talk a little bit about different topics in personal finance. And an interesting topic you brought up, Mr. Subramanyam, whether or not one needs to nominate somebody if they are holding in either or survivor mode. What exactly is the advice? Is it just a thumb rule that there is always a nomination required?
See, the law says only when you're a single holder, you need to nominate. Otherwise, if you're holding together, like either or survivor, normally let's say husband and wife, or if a person is not married, the person and his mother or his father, he or she is holding with the parent. The thing is, people think when you're holding it as either or survivor, you don't need a nomination, which is legally correct. But it makes no sense, because if there are husband and wife who are holding, it makes sense to nominate the children. If you have a major child, very good. If your child is a minor, still put a nominee and have a guardian. Because if something were to happen to both the people, if the mother and father were to both meet with an accident and one person is dead and the other person is in coma, there is no way how anybody can access that money. And if both of them die, then the children will never be able to access the money. And it is free, so you must do it. So if you are making any investment in any mutual fund, even if you're holding it as husband and wife, please put a nominee. It makes sense to have a nomination.
Okay, these may be topics that people do not want to discuss, but there's just so much importance to it, and one really needs to know that if you want to make sure that your wealth is retained and that your children get the benefit of it, it is very important to go for these nominations. And I thank you for bringing up that topic as well, Mr. Subramanyam. Let's get to the questions then, loads of them for you. First up, we've got a question coming in from Rakesh via email. He says, I earn 72,000 rupees per month and I'm investing in the following funds with a long-term goal of my child's education. Can you please advise me? So which funds is he currently putting his money in? Well, Axis Long-Term Tax Fund, Motilal Oswal Long-Term Tax Fund, Mirae Asset Emerging Mid-Cap Fund, DSP BlackRock Small Cap Fund, and Mirae Prudence Fund. So do you firstly think that he's, just diversified way too much?
Yeah, I think so. And a lot of mid-cap orientation is also there in the fund. I don't see why a person should need 2 or 3 ELSS funds, which are tax saving funds. So he needs to reduce the number of tax saving funds. He can stick to just one of them. And he has to get out of some micro cap funds and get into some bigger funds like the HDFC Equity Fund or the Templeton Prima Plus Fund, the Franklin India Prima Plus Fund. So it makes sense to put into those funds which have a longer term orientation and have a larger cap orientation. So I think you should do that.
All right. I hope you've taken note of that advice. Mr. Subramanyam as well has given us some of the stock funds that he thinks that you should look to exit, like the DSP small cap as well as the Axis long-term tax fund, and given a lot of other recommendations in terms of the equity, HDFC equity fund, the Franklin India Prima Plus, as well as the Franklin Blue Chip Fund or the HDFC Top 200. Those would perhaps be more prudent for you to invest in, Rakesh. Next up, Animesh is connected with us via Invol, and he asks, what should be the ideal mix of large cap, mid cap and balanced funds in my portfolio for my retirement, which is 25 years away? We tend to get this question quite a lot with respect to what the ideal allocation would be. And Mr. Subramanyam, is there a magic answer to that?
Actually, no. Because what happens is when you're sitting in one particular country, you look at certain asset classes. Like if you're sitting in India, you don't look at European equity or American equity as an asset class at all. But if you are sitting in London, you look at Indian equity as one asset class. Because we are sitting in India, we tend to think of large cap, mid cap, micro cap, small cap. It doesn't make too much sense. Even if you were to understand all this, we have no clue that 25 years later which fund would have done well and which would have done badly. Largely for a young, fresh investor, if he's got 25 years away, if his retirement is 25 years away, which means he's about 30, 35 years of age, he should look at putting 50-60% at least in large cap funds. Once you put 60% in large cap funds, you have 40% balance, you put maybe 20% into small cap funds and 20% into mid cap funds, you should do well. But suddenly if you see mid caps have done very well over a 4 or 5 year period of time, you might as well remove some money and put it into a large cap fund. That's what you should be doing, but it's very difficult to guess. There is no single magic bullet which you can take and say this will work. We don't know. You are anyway investing, and every few years have a look at which funds are doing well. If the mid cap is doing well, remove some money from mid cap and put it in large cap. If the large cap is doing well, remove some money from large cap and put it in mid cap, because going forward the other one will do well. That's about all.
But do you reckon that definitely for someone looking at, a fund allocation exposure, the maximum should definitely be with the large cap?
Yeah. See, what happens with large cap is you will have lesser surprises. You have the bigger companies, the Mahindra and Mahindra, Tata Motors, Maruti Suzuki, HDFC and Larsen and Toubro. These companies won't surprise you. They will not go to zero. None of those things will happen. So largely you want a stable portion, right? 60-70% is to be a dal chawal kind of a thing in your diet. So that's what you'll have. The other things are more of additions. You have it, you don't have it, you won't really miss it. But at certain points of time, it will look like, wow, the others did very well. But it's okay. You'll have to live with that.
Okay. So you need more of the dal chawal in your portfolio,
I think. You need the stability,
Yeah, a sense of stability, which comes in the form of large caps. So while there may not be any, magic formula or some rule for this, Mr. Subramanyam said that close to 60% can be invested in large caps. And of course, it depends on how these sectors as well perform. The mid and the small caps, you can decide or take a call on the allocation accordingly. Let's take a quick break right here on the show. We encourage you to send in any questions or queries you have for Mr. Subramanyam as well, or any questions that you would like answered at a later date in the future. For now, we'll slip into a quick break, come right back. On the other side, we'll be talking about the redeeming of mutual funds and what the right time is to do that. Akshay is talking to me. Great to have you back with us. Thanks so much for staying tuned. This is The Money Show and we're in conversation with Mr. P.V. Subramanyam. And let's get on board then the next topic of discussion. And, it's so important to understand, Mr. Subramanyam, how early is too early when it comes to retirement. What exactly would be the right time to start investing, to start saving for retirement?
It's a very difficult question to answer. Imagine going and telling a 22-year-old that you should start saving for retirement. Very difficult to convince this kid to save for retirement because maybe his grandfather is just retired, his father is still working. So he does not even understand. So what you have to do is to explain the power of compounding. So even if this kid were to start with a smallish amount, say 1500 rupees or 2000 rupees for retirement, he still has about 30-40 years to go for retirement. So what happens is his money works for a very long time. And because his money works for a long time, he creates a huge corpus. With something like 3000 rupees, he'll create a 1 crore corpus. That looks good. And going forward, he can keep increasing the amount. So the earlier you start, the better off you are. And the later you start, the more money you'll require. Only thing people don't realize or don't accept is today with longevity, you're going to have a very long life in retirement. You may have 30, 40 years to live in retirement. So you need to be prepared for that. So the earlier you start, the better off you are. The smaller you start or bigger you start doesn't really matter. The N, which is the number of years for which you save, is going to be very important. So the early start, small amount, big amount, whatever, and if you can increase it by even a smallish 5% per year, so that would also add to a good amount by the time you're 60.
Okay, so the amount is immaterial, but the fact that you've taken the initiative, the earlier you start, I think that's the point that you would really like to stress on, and that you brought about in your discussion as to when you should start saving for retirement. Well, let's get to another query which has been sent in to us, this time by Mr. Divakar Roy. He says, I am a regular investor in mutual funds. I earn good returns and I need the money back in 6 to 12 months. What's a good time to redeem it? Where can I look to invest if I redeem today? So, Mr. Subramanyam, what exactly would be your advice? It seems like he would, want the use of funds at an earlier date. Is there some sort of, advice that you would have for him regarding the same? And what would be an alternative or an alternative asset class perhaps that he could look at?
I mean, look at what happened to Bitcoin.
Yeah.
Last week you felt like a billionaire and today you're feeling like a pauper, right? The same thing, the equity returns can also be very finicky. So if you've got something 6 months away or 12 months away at this stage of the market, where every day if you hear TV channels and the papers, you hear a new high and it has crossed 10,500, it's crossed 34,000 and things like that, you know that the fall can be sharp. It can be maybe 10%, but it can be sharp. So what he should be doing, if he's 6 months to 12 months away, it's the time to redeem is now, today, not even wait for a couple of more months. Just redeem it, put it in a liquid fund, put it in a savings bank account, put it in a bank FD and start withdrawing from that whenever he needs, or exactly 6 months later or 12 months later. No point in taking a chance. Of course, if the amount is huge, more reason to do that. If the amount is not very huge, then maybe you should withdraw 25%, 30% every month over next 2-3 months. But my advice would be very simple. Redeem today, keep it in a savings bank account, and that's more sensible than keeping it in the equity market. Equity markets could just, your particular fund could go down. So that's also bad news for you. So don't do that. Don't take the risk.
Okay, I hope you've taken note of the advice that's been given by Mr. Subramanyam. But let's, since you brought up the topic of Bitcoins, I'm going to take the liberty to question you about it as we have previously. Now it seems like there's a little bit of panic setting into the investor community because it's been fairly volatile. But this is not something that's been unanticipated. Like you said, one day you're sitting, you put in a small amount of money and, you look at the screen, you're a millionaire or maybe even a billionaire. So it's a very volatile currency, form of investing really, or trading. And the fact that it's not been regulated by the Indian markets, but still, so many people ask me, given the fact that I host this show, that why aren't you putting your money in Bitcoins or something? And I try to warn them that, one needs to really be safe. But what would be the response, Mr. Subramanyam, that you would give them?
No, I keep telling people that you have some money which you've saved, which you require for an immediate requirement, maybe kids' school or kids' college fees or things like that. And you've got another amount of money which you have invested, which is for your retirement and things like that. You don't want anything to go wrong with this. There's a third set of money which you could call it gambling money or whatever you want to call it.
Mad money.
Yeah, you do whatever you want with that. You put that money, then it's okay. But the question is, will you be able to take the volatility? Even suppose you put 5 lakhs and it becomes 50 lakhs or a crore. And if it falls to 50 lakhs, then you look like, oh my God, mera 50 lakh chala gaya. Actually, it's not true. It's only a 5 lakhs which you started. But your ability to take that may not be there. It could go down further. We have no clue how it will be taxed. We do not know how you will hold it. We do not know what will happen if you lose your password. It's got a transaction cost. There's a buy price and a sell price. It's expensive. Why would you do it? In this country where in regulated markets, if you get stuck, you can't remove your money. You put money in some mutual fund where it's stuck and you are unable to remove. You're running pillar to post, signature defer, bank attestation. Why would you do it at all? It's too damn risky. Just stay away. Anything you can do in a bubble is only one thing. Stay away. Just don't go near it. It's not worth it.
Okay. That's the advice coming in when it comes to Bitcoins. Just stay away. It's just far too risky. But let's move away from that, and something that I spoke about in the headlines as well, and I'm wondering, Mr. Subramanyam, whether or not you can comment on this. The government relaxing the risk-weighted rules for housing finance companies. So this thereby increases their overall liquidity. And do you think that, given the fact that there will be more competition now for them to lend more, and the consequent lowering of interest rates, that the loans charged will be lower in order to attract more customers? And how would home buyers or look at this?
Actually, if you see the real estate prices compared to a person's salary, it's completely gone mad. In cities like Mumbai, a fresh graduate, even assuming is a management graduate or a chartered accountant, it is some 50-year salary and 40-year salary to buy a small house. So the ability to take on such a big loan for a long period of time is to be questioned. So interest rate going up or down a little bit may not change much. Yes, the liquidity goes up, the profitability of the NBFCs goes up, so it is good for them. So maybe it'll the amount of money available for housing finance might go up a bit, but I don't really think it will have too much of an impact on the unsold properties in Bombay. People are unable to buy property because the property prices are high, not because the interest rates are high or low. So I don't think it will have too much of an impact, but yes, some marginal effect. Whatever is available is good for the real estate industry, which is struggling to sell its properties.
All right, Mr. Subramanyam, thank you for talking to us on a range of topics, from bitcoins to mutual funds to housing loans. It's been great having you with us on the show, and of course we encourage all of our viewers to send in their questions and queries. For now, enjoy the long weekend, have a great and Merry Christmas, and we'll see you right back on Tuesday.